More than 3,000 airplanes have been put in storage.
That's 50%
of the United States
active fleet.
When business as normal is no longer
normal.
This is
your economic emergency kit.
Money Talks.
We're back. I'm Corey Harper with Casey Smith and Jim Crone. We've got a question from our good friend Ed Kelly, who writes us, with the strong trend toward online shopping and therefore a strong trend toward home delivery, are there some companies that should be invested in that are part of the shipping delivery arena? Not looking for a shooting star, but companies that are tried and true with solid long-term growth potential. For instance, companies that produce boxes, packaging companies, logistics, etc. Several come to mind right away. If you want logistics, there is a company, and we've invested in this before, recommended it for clients, C.H. Robinson Worldwide. They're a contract type business. They don't own assets as far as, they might have furniture, fixtures, and equipment, but they don't have trucks and trailers, but it is a trucking company. So basically they go out and deal with shippers who want trucks, and they, on the backside, then deal with owner-operators and independent drivers and marry the two together, but they're the middleman, if you will. It's a pretty good business model. When things slow down, they run the price down on the supplier of the transportation, so the owner-operator or whatnot. So their profitability actually gets better in times of recession or slow economic times. There's not a whole lot of growth there, about 4.5% over the last 5 years, but it is expected to grow a little faster at about 8.5% going forward. And it's a reasonably profitable company. There's a couple of others that I just want to point out, since you're talking about packaging, maybe WestRock. This is a combination of Mead Westvaco and Rock-Tenn Corporation, two paper companies, make boxes basically. There's, again, negative growth here, but it's very slow. So negative 0.03% earnings growth in the last 5 years. Approximately 9% revenue growth over the last 3 years. So it's just real thin margins is the toughest part with this one. I did something that I wouldn't normally do in this regard. So I went and looked at the supply chain for somebody like an Amazon. Obviously, UPS is one of their big suppliers. It's about 5%. And, UPS has been a good business for a long time. They've got some really weird numbers when you look at their debt. Basically what you have is debt to assets about 48.7%, which doesn't look terrible, but when you look at their debt compared to the equity, it's 862.2%. Holy cow.
Some good leverage right there.
They don't have much in equity, probably previous losses and serious leverage. Their earnings growth over the past 5 years has been about 7.7, so a little better than a C.H. Robinson or a Mead Westvaco. Obviously, I say Mead Westvaco, WestRock, I'm sorry. But when I looked a little deeper, the company has been buying lots of, Amazon that is, has been buying lots of trucks. They've been buying their own trucks. So I did check into that. The company called Shyft Group is SHYFT, and their symbol, I think, is SHYF. They've had significant growth in the last 5 years. It's been over 40%, expected to continue growing at a double-digit clip, 15% in the next 3 to 5 years. Very profitable, but it doesn't meet our criteria for investment based on financial strength and safety. So I would have to tell you that you might check that one out a whole lot better yourself. But that is a good thought, Ed, and we appreciate you. Appreciate your call.